Well, Jerome Powell opens the door to a 50 basis point hike in the March FOMC meeting. But with markets largely priced for this, both in terms of rate expectations and also US dollar positioning, and with the non-farm payrolls and US CPI print looming large, it could get a little bit wild and a little bit spicy in financial markets over the next week or so. We break it down in the trade-off. Well, hi, I'm Chris Weston from Pepperstone. I'm going to be joined in 2 seconds by mon ami, Blake Morrow from Forex Analytics, and we're going to be discussing all the factors that are going through in this crazy world of markets, and it's going to get a bit wild, as I say, over the next week or so. There's a couple of event risks that everyone needs to have on their radars, whether you're trading the US dollar, whether you're trading gold, equity indices, rates, or whatever it is at the moment. Markets could get a little bit wild. I think if you look at the options market in terms of implied volatility, you've started to see people betting of more intense movement coming through the markets, which is fantastic to see. We all like a little bit of movement, and it's really how you respect that movement as a trader that will keep you in the game going forward. So, Mr. Morrow, come back into the programme, if you would. How's it going over there in Scottsdale?
It's going great, but I'm at the tail end of my nice weather, and I'm bracing for the hot weather now. So, other than that, everything's great.
We're the opposite, man. So we've just gone through what's been a fairly poor summer in Melbourne, and I'm saying that as an Englishman as well. But we're sort of getting into the tail end of it, and it's going to start getting a bit cold as well. So I'll take your heat every day of the week if you want to swap it for my cold weather. But I tell you what's not going to get.
Flip-flop.
Sorry?
I like wearing flip-flops.
They call them thongs, mate. It's thongs over this way. But and you'd look really good in flip-flops, I'm sure. And budgie smugglers as well. But we won't go there. I'll tell you where it's going to get hot. It's going to get hot in financial markets. So let's go into the markets and let's go into Topical Thunder. Okay, let's go into the rates market because we talked about it. We seem to talk about it every week. It's this obsession that we've got with interest rates, and I've made the case recently that rate hikes to be priced in, and the market seems to be quite resilient in that. I know we've seen, post Powell's semi-annual testimony to the Senate, some big vol coming into markets. Rate expectations have moved up. The dollar's strengthened, and we saw equity markets down a little bit. Gold got hit pretty badly. Silver even more so, but. We've been pretty resilient in the face of this continued steepening in the terminal rate in the US. I think that's because growth has been pretty good. And the market's saying, look, we're not going to necessarily go out and short risk in any kind of great size until we do see growth dynamics faltering, despite what we've been seeing in bond markets and rate markets. And I still believe that's the case. I think, until we see growth really coming under pressure and the word recession getting used again, that we'll see resilience playing through. But I think if we look now, Blake, the market is saying that on balance, we're going to get a 50 basis point hike. We can focus that in the non-farm payrolls because that's going to be one of the big factors that will drive that pricing. But at the moment, we've got 43 basis points of tightening being priced into the March FOMC meeting. The terminal rate now is at 562 or so 109 basis points of cumulative pricing. Going to Europe, and we're seeing nearly 50 basis point being priced for next week's ECB meeting. We've got other central banks. We can talk about the divergent side of things, which are on a pause at the moment. But you've basically got the Fed and the ECB as the most hawkish central banks out there. And Jerome Powell stepped it up, didn't he? And he said, I've got game here. I'm bringing the hawkish game back into town. The dollar's responded quite nicely to that. So we're looking at a situation now where rates volatility has just ballooned. So how are you seeing this at the moment?
Well, first of all, he had to come out hawkish yesterday. I mean, just think about he's on the center stage in front of legislators that are really, talking to their constituents, and they're talking about inflation. All they hear about is prices and inflation. So of course he's going to get hammered, and of course he's going to come in and tell them a certain story. He had to. Rates market's interesting, and I think it's a lot like any other market that you deal with, whether you're dealing in a bull or bear market. Until the last person is out and unconscious and not and folds, then we're going to continue to see the rates market continue higher. I still hear people that believe that interest rates are going to get cut sometime in 2023. And until those people get knocked out and dragged the hell out of the room, we're probably going to continue to see rates continue to go higher near term. And I don't think anybody should have been surprised by the FOMC chairman.
Let me ask you a question, Blake. Let me ask you a question. So they've gone down. They've stepped down to 25 basis points. To step up now again so soon to 50 basis points, that's got to be a bitter pill for Powell to swallow. It's not a great look for the central bank.
It's not, but it's not also, but you look at the data consistently is stronger. So I think it's going to really hinge on our next topic, which happens to be jobs.
Segue.
Look at that.
Well done. You're like a professional at that.
Chris. Yeah, I know that was pretty good. It's really going to hinge on our jobs report. And, we got a glimpse of what to expect with ADP today, which came in better than expected. But also, and I know it's a volatile number and some people are not going to hang their hat on that, but I don't know if you caught the ISM data last week either, and the employment components there, and we have the JOLTS jobs report came in, pretty healthy and strong. So there are plenty of jobs available. So it does look like our jobs report will at least come in somewhere in line. I know there might be some revisions. That's what people are going to be focused on. But how are you going to play this, Chris? Because first and foremost, I think people continue to bet against the U.S. economy, and they hope that they're going to start to see weakening data that helps the stock market go higher from this point. But how are you going to play it? I mean, I look at the dollar. The dollar looks very strong and rambunctious, to be frank, and it's breaking out against so many currencies. You even look at the dollar Swiss that fell following the Swiss inflation data this week. It reversed course, and we're knocking our head right up against 94.30 there. When you see a breakout of the dollar against everything, it's hard to contain it. And how are you going to play it? I mean, I know where I want to play the dollar short. That's going to be against the yen, and I'm still playing the yen playbook, not so much the dollar. But what would be your bullish dollar scenario, and what would you be playing?
It's just so hard, isn't it? Okay. As a trader, right? So I'm looking at the form guide. The non-farm payrolls has beaten expectations in the last 10 consecutive non-farm payrolls reports. It's beaten in 11 out of the last 12. So last time it missed, I think, was April of 2022. So the form guide suggests that we beat expectations. What I did is I looked at the top 5 ranked analysts who have been calling the payrolls number, and their average call is 250. The best ranked caller of the payrolls is SocGen. They've got 280. So I think, the market, based on those two factors, the top 5 and also the form guide, I think the market's positioned for a strong number. The consensus is around 220. We've got to look at the earnings. Average hourly earnings matter, if not more, to the market. And we're looking for 0.3% month on month, 4.7%. So that matters a lot. Take a simplistic playbook. The market's expecting a strong number. So I think if we get a weak number relative to like 150 or below, there's going to be a much more pronounced move in the US dollar to the downside than if we get a hot number. But where's the probability? The probability is we get a hot number. So would I be shorting dollars? I think that's the way to look at it.
I agree with that, but that was my thinking going into the Powell testimony. Everybody's expecting a hawkish Powell. He came out and the dollar absolutely was on fire. So
I think that's because the market expected him to sort of veer towards this 25 basis point. He didn't. He showed no propensity for or bias for a 25 basis point. And he said we'll step up the pace if we need to. And everyone says, well, where's the balance of risk for payrolls? It's to the upside. Where's the balance of risk for CPI next week? It's to the upside. A 50 basis point now is the default position of the market. He opened the door. He said, come and have a piece of this 50 basis points. So the market said, we'll take that every day of the week. We'll take it off you. And that's where we are now. So, again, sorry, producer, I'm running over time. But where do we think the payrolls and the CPI are going to come out? Above consensus? Probably. But where's the shock factor? It will be, obviously, given that the market's positioned for that, you're going to get a big reaction to the downside in the US dollar if we miss on both of those. Is it likely, unlikely there? So anyway, I want to go into the strategy side of things, because one of the factors that we've been noticed recently, post Powell, when Powell said, I'm bringing my hawkish game, we've got Christine Lagarde, bringing her hawkish game as well. The ECB, Elizabeth Schnabel, for example, are bringing that. They're clearly more worried about inflation than any other central bank in Europe. But then you've got the RBA, who have said pretty much that, look, we're probably going to get a rate hike in the April meeting, and then they'll go on an extended pause, depending on what happens with that late April or Q1 CPI print. But they'll probably go on a pause. The Bank of Canada have said we're going on an extended pause, but we just retain the ability to raise rates if we need to. There's all other central banks. Bank of Japan, obviously, very, very bearish, very dovish. But you've got this wide divergence that are creeping up, and that's supporting the dollar. It's supporting the euro to an extent. The Aussie's getting hit, and you're seeing that in yield differentials. So one of the big trades that we like has been this central bank divergence. The dispersions that you're seeing in stances is clearly resonating in trends in FX markets. So how much have you noticed that, and how are you trading it?
Well, first of all, I don't know if you recall the last week's, my play of the day was the EURUSD and to the upside because the RBA is they showed their hand. They're going to be steady as she goes. And you're right. That those central bank divergences, you can see it playing out in the EURUSD, the Euro Canadian, the dollar Canadian, which I'll talk about here a little bit later. So make sure you stick around.
Where's the trade du jour? Mate, go and pull up a chart of Aussie Mexican peso. The RSIs on the 14-day RSIs at 13. I haven't seen anything like it. Clearly, I'm not going to be going on holiday to Mexico anytime soon. But yeah, that is so grossly oversold. The trend is just dun 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 down down down. Would I be betting against it? I mean, that has got carry every day of the way. That is central bank divergence 101 right there. Go and pull up a chart of Aussie Mex. You see that front and centre.
Yeah, you do. And, the dollar Mex, and I'm trying to catch a falling knife piano and getting whacked in the head every day with the carry costs.
You're better than that, Blake. You're better than that.
But no, come on, man. I these are my plays. This is my jam, Chris. But anyway, there are a few, I did not put it as one of the markets that I'm going to talk about today.
Yeah.
But yeah, those central bank divergences, I think you're seeing them in the FX market quite substantially. And the thing is, what I find most troubling with the trading community is people have a hard time understanding that when central banks, what moves interest rate or what moves currencies is central bank interest rate expectations and interest rate moves. So when those interest rate expectations diverge like that, you really have to respect them and try not to fade them. And and that's why, like, I see the Euro Aussie blasting higher, and it you got to be really careful with that because that trend could continue. We just heard from the RBA 2 days ago. So
yeah, that's right. But I think I think when the second most important currency in the world for me, other than the US dollar, is the Japanese yen. Because you've got the most dovish central bank there. And I know we got a Bank of Japan meeting today, which will be a non-event, but once Oeda comes in and he's got a bit of time to mess around, and given what we've seen from Tokyo inflation, that end of yield curve control is going to be such a big thematic, and what pension funds in Japan do with that capital when we start seeing a high yield target going forward. That's just such a big elephant in the room. It's not there yet, and it may not happen for a couple of months, but the Japanese yen, I think, will be, we've said it before, I think the second most important currency in the world at the moment, but certainly the euro is looking quite good there as well.
And I believe it's going to be into the remainder of 2023, Chris. I could not agree with you more. And I know we're going to be highlighting it every week here at the Trade Off, I'm sure. Now I'm going to turn our attention to the last topic, which is the biggest topic I see reported on really over the last 24 hours is the inversion of the yield curve continuing to steepen and what that means. And I mean, you got the 2s rallying, 10s kind of steady, that it just continues to invert. And people, well, I got to ask you this because you're the rates expert in my view. And that's one of the benefits that Pepperstone has and Pepperstone traders have is having you at their disposal and your real knowledge of the rates market. So
thanks,
that's one thing I want to say. But with this increased yield curve inversion, does it tell us, Chris, and this is where I'm going to ask you, and because I don't necessarily believe it, but does it tell you that this is going to be a more extended and pronounced recession that we might be facing, or is it just a round number that we're hitting? So what are your thoughts there?
Well, I don't. As a short-term trader, I'm not so sure what benefit, trying to extrapolate a recession. I get what you're saying, but and this isn't a criticism of your question, but as a short-term trader, using the yield curve 2s, 10s, and we just take that one for example, which is trading negative 108 basis points at the moment, deepest inversion we've seen for years. getting that and what information that's going to give us to benefit our trading. I don't think it's going to give us anything whatsoever. Where this comes as an interest to me, if you want to go and trade the yield curve, it's basically by going long or short the front end and going long the back end. I mean, it's difficult to do so because you've got to get your duration risk mixed up, and obviously 2-year treasuries move or in theory at a slower pace. So you've got to get that duration mix. It's very difficult for people to trade. But what I will say is these curve flatteners effectively by people going short twos and going long the 10-year or the 30-year, so that sort of comes together. It's such a well-traded trade that if we get a weak non-farm payrolls number, you're going to see steepeners. You're going to see a lot of that coming. That curve is going to steepen so rapidly as twos come down, as rate hike come out of that front end. So, I wouldn't be touching it to myself. I think it's such a well-worn trade. Everyone's in it. Every macro trade is so overweight, curve flatteners at the moment, that we could see such a pronounced move if we get even the slightest miss in payrolls or CPI. But yeah, as a trader, if I'm trading the dollar, a flatter curve is not generally good for the US dollar, but the US dollar's not really reacting to it. So I'll throw this back to you. Everyone's talking about it. I completely agree with that. And it's generally when we see steepeners coming through that people are saying now people are positioned for the recession. But how are you using it for your trading?
Well, I'm not, and that's why I hear people consistently talking about it. That's why I want to bring it up for Topical Thunder. Yeah. Is that I don't think it really matters to us. And if you're one of those people saying, well, the inversion of the yield curve, we're going to get a recession, I'm shorting equities. I mean, you've had a tough time this year. I mean, yeah, equities have slid down a little bit, but really, people have been talking this for the last 6 months.
I'll wrap it up here. Yeah. The way to look at this is you've got this. It's like a tennis serve, right? The ball's been tossed up, and we know it's on the radar. It's when both the 2-year Treasury and the 10-year Treasury yield are both coming down, and the 2-year is falling. The yield is falling at a faster pace that causes this rapid steepening. That's when equity markets are going to suddenly come down, because what you're seeing then is growth really coming into its own, and people saying growth's under pressure, rate hikes are being priced out, rate cuts are being priced in, and that's when you get that rapid steepening of the curve, but both yields are falling, and that's when you start saying that's the time to start shorting equities. So that's the trigger point that you need to look out for. Anyway, let's go into some of the charts that are making mine. Let's go to That's a Setup. Blake, I want to talk about the US dollar. Can't go past it. I know you've got US euro dollar on the back of that. I've got the Dixie. Can the Dixie kick? Can it kick is the question I wanted to ask you, and I suppose you've got to answer that in euro dollar, given that the dollar index is 57% weighted as a basket towards the euro. But look, if I look at price action, what I love is you've got that sort of that blue horizontal resistance level that came in, 104.91. Price sort of closed above that. And what we like after the Powell testimony is that its price closed at the highs of the day. That shows that the bulls have been absolutely dominant in that bar. They were right to the bitter end until we got the rollover and the new candles. What we've seen in the candle, just seen there is a doji. So there's been indecision. We saw market create a higher high. And then the bears pushed it back down. It makes a lot of sense, right? So, that the market's position long of US dollars, not that long of US dollars, but we haven't had any CFTC data for a while. But, the investment banks are saying that market's sort of net long, but not by any kind of extremities. But people are sort of saying, well, the rates market's definitely very short. The yields are very high, and if we see a miss, then it could be a big downside move in the US dollar. So it makes sense that we've seen that indecision. The question for me is, I'm going to put a gun to your head, metaphorical, of course. Does this kick higher? How are you seeing this?
Well, again, it's you got almost every, if you take it, think of it like an engine. You almost have every piston firing in this dollar trade. You've got every currency pair breaking out or breaking down. There's just a few laggers right now. One of them, the Swissy that we talked about earlier, and then you got the dollar Mexican peso doing whatever the hell it's doing, and no one can figure it out. Well, we can figure it out, but you know what I'm saying.
Yeah.
So because of that, I'd say gun to my head, the dollar's gonna defy odds. And, as long as the U.S. economy continues to defy odds in this February jobs report, then I think the dollar's gonna have to do so as well. And kicking and screaming and probably kicking down a lot of traders on the way.
In terms of the fundamentals, I know we talked about the price action, and this is one that needs work, but it could start trending to the upside. Is the US economy right now the least dirty T-shirt, the best house in a shabby neighborhood? How are you seeing that very quickly?
Very quickly, I would say, and I'm in one of those very extreme areas that lives and dies by the sword a little bit as far as a U.S. economy goes, because it's, a lot of high end people live where I live, and it's still, people are still spending and people are still doing things. So I haven't seen it really affect, the U.S. economy, and so I do think we continue to be the least dirty shirt, at least right now. So we'll see. Maybe that yield curve inversion that we're seeing, maybe it will eventually have an effect on the U.S. economy. But I day to day, week to week, I'm not feeling it, and I don't think the dollar is either, based on your chart. Let's go look at the next chart, which is going to complement what you're talking about, Chris. Is the euro, and I know the euro is going to be probably one of the better performing currencies. But you also have to realize that it actually has a head and shoulder pattern right now. It's coming into a 618 retracement. It's kind of holding there above this 105.40, 105.30 level. A break below that's going to usher in at least a move to the 200-day moving average. And I think that's a setup that we need to be paying attention to. Now, a lot of people look at this and say, well, could it really make a move to parity? Based on the chart formation, it could. But based how the euro is performing against every other currency, euro sterling, euro Aussie, euro Kiwi, not euro Mex, but euro anything else, it looks good. So
it's a dollar play. It's a dollar play. It's a dollar play.
I think it is a dollar play, but you probably could actually find a better dollar to play it against. You could probably short the Aussie dollar, or maybe the Kiwi dollar would even be a better trade. However, I wanted to point this out because it is a setup. It's got technicals. The 200-day looks like we're salivating to get to the 200-day moving average on a strong jobs number, and maybe the days, going into the CPI going into next week, we could possibly reach for it on a strong number. So that's what I see as a setup. What are your thoughts here?
Yeah, I mean, fundamentally, I think you're right. I mean, we always choose, if we like the dollar, we choose the weapon to express it, which is the weak currency, and the euro's got a lot going for it. A lot's priced in. We got 50 basis points, pretty much a done deal for next week's ECB hike. If anyone wants to take the other side of that trade, I'm all ears. Write in the comments. I'd love to take your money. Joking. But we've got 150 basis points being priced in now. Rates going above 4%. So you're looking at, from here, the most aggressive central bank in G10. So the Fed are going to raise 106 basis points, so it's been priced in to the terminal peak pricing. The ECB are going to raise 150 basis points. Another central bank in G10 that's going to come close to being more aggressive. Is it priced in? But is that going to support going forward? And there's a lot to like, because ECB European inflation expectations are still moving higher relative to any other country, and that keeps the ECB very concerned about that. So I like the euro from that perspective, especially when European natural gas prices have been absolutely clobbered. But yeah, like you say, you make a very valid point. This is a setup. And this is a setup that if it breaks through that could have real ramifications. So yeah, big one, and put it on the radar. Talking about that, because we did talk about head and shoulder patterns on the Aussie dollar a while back. It was my play of the day a couple of weeks ago, and it's just reached the head and shoulder target. So if we can bring up the euro Aussie, because I want to marry that up, because we've been talking about euro there. Blake called this one really well. But we can see that we've broken out now. We've closed above the December highs that we saw. So when we're marrying this up in terms of central bank divergence, we are seeing a diverging picture in terms of what's expected in rates from the ECB and also from the RBA as well. And you can see that the price actions really reflected that. So we've got a strong bullish trend. Price is broken out. The question now is can we go into that, obviously the big resistance levels that we got from late 21 into early 22, which you can see in the sort of black horizontal resistance level there as well. It's trending, but the question for you, Blake, then is if I look at this fundamentally, I'm asking, is too much being baked into the rate markets? What's the propensity for more rate hikes to be priced into the Aussie curve? Price is true. That's all that we care about, price action. It looks strong, but can it continue?
Chris, I think it can continue. Just for the record, I played this twice on the long side from last week, right after the show. Last week, I was long for a couple of days going into the RBA. exited, booked profits. I bought it again today, and I took profits, and I'm going to buy a dip tonight if I can get it. So that's just a simple. You want to know what my playbook is here? I'm playing it to the long side, and I think it plays right into that resistance there, and could potentially even go higher. So the thing is, Chris, is all you have to do is sprinkle a little risk aversion. Do a S&P overlay of this chart, and you'll realize if the S&P actually starts to break down, or any, and the risk markets start to break down, the Euro Aussie is one of the best trading vehicles in that environment. You'll see it rally even further.
I'm going to take your S&P, and I'm going to raise you high yield credit spreads. The equity market always looks at credit, right? It's 4 times the size of the equity market. But if you look at high yield credit spreads, they're multi-month tights at the moment. If they start breaking down, the equity market will notice that. So one of the reasons why I think the equity market has been resilient, and yeah, look, it's come under a bit of pressure recently, but one of the 2 reasons why it's been so resilient is that growth is still holding up pretty well, despite rate hikes. If growth was to falter, and some of the high frequency data starts to falter, one thing. But if credit spreads start to widen, especially on high yield, especially in this interest rate environment, then the equity market's going downtown to Chinatown, and I've set you up for that one. But that's for me. That's the issue. So this Aussie Euro Aussie trade is a part dollar play as well. So if the US dollar does rally, you are going to see the Aussie come under pressure relative to the euro as well. So for people who are long Euro Aussie, you want the US dollar to strengthen in that situation as well.
Well, that's some great information, Chris. And I'm going to tell you, one of the best places to be here is on the trade-off. And I know a lot of you guys love to salivate. You're just waiting for this show to come out every week, and we're glad that you're here, because we're going to be talking about a lot of really, really crucial topics in the months ahead. I can guarantee you that. All right, let's go to the last setup here, because I got to pick on China a little bit. I was listening to a show earlier today, Chris, and I was listening to this analyst talk about the 2 sides of China. And I wanted to just take you over to the China 50 here. We are coming into some pretty key support. It's a 38% retracement. And really the question comes into, everybody's going to ask is, what has been priced in for China? And I'll tell you, the markets right now are looking very vulnerable. And so a breakdown below that 38% retracement is just something that you've got to be aware of. And I don't play the China 50. I don't play this index, and I don't play the CFD like a lot of your traders do. But that doesn't mean I'm not paying very close attention, because if that breaks down, I am long the euro. Well, was long the Euro Aussie earlier today. I'm going to try to get back again tonight. And how I'm going to be playing it is pounding the Aussie. If this breaks down, if you see China break down, I'm going to step on the Aussie's neck. I'm also probably going to be looking to short copper. Those are plays that I'm going to be playing as China breaks back below the 200-day moving average. If we start getting down towards that 12,400, which I think is a very doable target, that's what I'll be looking at. What do you think of this setup,
I think you
Chris?
bring up a great chart. So last week I talked about the Kiwi dollar as a trade, but what I wanted to do is I wanted to buy a closing breakout, and we didn't get that breakout. It didn't even come close. And I was the premise of that was that China was going to have a rally. We didn't see that happen, so the trade was never filled. But I still stand by the logic. I think it was a logical trade. But what we've actually seen is China doing the opposite now. There's been some incorrect concerns around the MPC meeting on the weekend and their 5% target. That target was set in December before they really even knew much about the reopening. I think that 5% is going to represent a floor. Previously we've seen targets being smashed left, right, and centre. So that 5% is a floor. But what I think psychologically it's done to the market is told us that they're not going to stimulate from a monetary perspective anywhere near as aggressively as some people had hoped. And we're seeing a bit of despondence coming through in the equity market. So this is a key chart for me. If it breaks through those lows, Aussie Kiwi, that looks very similar to the Kiwi dollar. So Aussie Kiwi are going to come under pressure. You're going to see that expression in that central bank divergence trade. Euro Aussie is going to go higher into those targets there as well. So you bring up a great chart. The correlation with the Hang Seng, the HK50, the China 50 there is very strong between those antipodeans and copper as well. So yeah, a really key chart. If it breaks through that, I think that's going to be very powerful indeed. Anyway, let's go to play of the day. Let's see what's on the mind there. Very difficult for me to make a play of the day because you've got so much is correlated to this non-farm story that we talked about there that I don't really want to be making too much in the way of calls and trades ahead of that situation. I'd rather react rather than prophesize ahead of that, because, as I say, the balance of risk is the bigger move in the dollar and the markets is if we get a miss, but I think that we're probably going to get above. So I'm going to have a look at the crude market today, because I think this is really interesting. Now, it probably sort of gets a little bit overlooked for other things, but we've got really clearly defined levels coming through in the crude market. So you can see this short-term double top around 80.38. We respected that one. It's also the 100-day moving average. You can see that sort of blue 100-day moving average, which has defined the upside in the crude market for some time. And again, so I think there's some really very powerful support resistance levels coming through in that double top 100-day moving average. Now, if we get a break of that, we're looking for small longs into that really strong horizontal resistance level around sort of 82.30. If it breaks through that any size, then I'm increasing my position size. I'm increasing my conviction levels around that. So I'm looking at these defined levels. I'm looking at the playbook. The market is going to push me into trades that I like. I like buying strength. I like selling weakness. Of course, on the downside, you can see that neckline of the double top, which comes in around sort of $75 or so. I think we'll probably see some scalping activity into that. But if it breaks through that, that's what I'm going to be looking to increase my short. At the moment, we're sort of trading a bit of a range, and I think that's going to be respected. But there's on the crude market, what I love about this is the market's respecting those technicals, and it's giving us clearly defined parameters to work with. So no trade on it yet, but I'm just waiting for the market to reveal itself. And when it does, I think that's going to be very powerful indeed.
Oh, so I think it's a great setup, and it actually might factor into my play of the day is the dollar Canadian. And you guys might remember this chart from a couple of weeks back. I keep a separate substack of charts that I use exclusively here for this show for the trade-off. And you might remember that Gartley pattern on the dollar Canadian, a break higher from 2 or 3 weeks ago. Anyway, we reached that target today, Chris, following the BOC. And the question that I'm looking at is, can we morph into a butterfly? And what happens with a Gartley pattern is they morph to butterflies if that rally or that trend continues, which could take us a whole heck of a lot higher. Now, you say you like to react, and NFP, I think this week, I think it's very important that you react. But if you can get into a trade and get into a nice profitable trade ahead of the data, like I hope the data is weak. I don't think it's going to be weak. There's my take.
I think
so.
That's right.
If I can get in the dollar Canadian some on a little bit of a dip, and I am not long, so I'm not talking my book, but I can trade it, get it long before it gets to like 139 and before Friday, that jobs report, I'd have plenty of cushion to move my stops to break even and possibly add on a strong number. And if it's a weak number, I get stopped out. So, that's my play of the day here. I'm not talking my book, but I am looking to actively get long the dollar CAD.
Yeah, it's a tough one, isn't it? Because any of these dollar pairs are going to be thrown around by the outcome there, so it's a difficult one as well. So everyone out there, just make sure you're watching your position sizing, understand how much leverage you've got in your position, understand how much margin you're placing down. That's going to keep you in the game, especially if you're running multiple positions into that situation. In this kind of potentially turbulent times, I like to take my leverage ratios down a little bit, give myself a little bit more margin to play around with, but that really depends on you as an individual. But yeah, obviously looking at those position sizing, your position sizing needs to be relative to obviously the count balance, but also relative to the volatility in the market. And if I look at 1 week vols in FX markets and across gold and in rates markets, they are pushing higher. Markets expecting movement. We need to react to that and obviously look at our position management around that. So anyway, just wise words from this old owl. And I hope you've enjoyed today. Smash the like button if you can. Leave a comment about how you're seeing the risks in non-farm payrolls and for CPI next week, which don't forget is the big Mac Daddy economic dollar release. Anyway, thank you for joining us. We'll see you for more next week on The Trade-Off.